Hello and good morning, listeners. Welcome back to Almus Market Mornings, your daily dose of global financial updates. I'm your host, Swaraj Rajagopal, and we have got you covered on everything from currency shifts to pivotal central bank decisions and important speeches. Plus, you'll gain expert analysis on macroeconomic data that's shaping the market narrative right now. Join us for this episode and navigate the markets with confidence. US bonds stumbled as expectations of a Federal Reserve cut cooled. The 10-year Treasury yield jumped 11 basis points to 4.20% as traders priced in a slower pace of monetary easing after comments from several Fed officials favoring a gradual approach. In positive geopolitical news, India and China have reached an agreement to resume border patrolling operations in both countries. This development suggests that disengagement process is complete, returning to the border situation to what it was in 2020. This has a positive impact on the regional stability. But market volatility remains elevated across stocks, bonds, and currencies, as there are a number of events, including US elections, the path of monetary policy, potential escalations in the Middle East, and the upcoming quarterly earnings. Good morning, JK. I think the surprise was the yesterday's rise in bond yields without any significant triggers. How are you reading that?
Yeah, good morning, Swaraj. Yes, it was a kind of mayhem in U.S. Treasury bonds with steep rise in yields on the 10-year, which is now at 4.20, and the 2-year now at 4.02%, way higher than the lows that we have seen recently. And yes, the surprise was that there was no economic data that could have triggered this kind of a move. But some market participants are, pointing to the new driver of the steepening as the so-called Trump trade. As the former president continues to, get a lead on the polls, and market participants are increasingly pricing in a red sweep, meaning the Republicans to sweep the polls. But I mean, that's too early and too much to assume, because overall it's a tight race yet. However, people are also recalling what happened in 2016 election when Trump won. The 2-year note yield had jumped over 50 basis points, and tens had jumped about 80 basis points in less than a month. And so markets are being cautious, knowing what policies Trump is likely to follow. The tariffs on various countries, particularly China, Japan, and Mexico, and also the immigration policies that could actually tighten the inflation. Another thing that has developed over the last 2 days is the wage settlement with Boeing, where there was a strike ongoing from the workers, and now the settlement has resulted in a 12% whopping increase in an annual pay, including bonus, and that is ensuring that higher wages will lead to higher consumption, and overall we are somewhere leading into a situation where inflation is possibly bottoming out, several factors indicating that. And so that's the reason why the bond prices have fallen or the yields have risen. And we as we all know, the background of US deficit and debt is not supportive of a lower yield at all. So unless we see a big slump in the economy, the yields are unlikely to come down much. And of course, there are also doubts as to how quickly the rates will be cut in the US. Of course, November cut is fully priced in. December is also at a 65% probability. The going forward will be how the inflation pans out. Also on the news was the US budget deficit grew 1.833 trillion for fiscal 2024. That's almost 2 trillion in 1 year. And these are not the situation that supports a lower yield. Yes, the agreement between India and China, as you said, was a positive development coming just ahead of the BRICS summit that is starting today. And it's a crucial summit where Russia is actually proposing an alternative to the SWIFT system and for dollar settlement among the countries in the BRICS. And these are some key proposals which will have a medium-term implication. Whether it will get through or not is something that we'll wait and see. But definitely the union is moving forward towards their strength, and that is something that the markets are noticing as well. On the European side, of course, it was a slightly different situation because some of the members, they were now calling that all options are open as far as the December meeting was concerned. They would like to see more evidence of disinflation before declaring victory, and they're confident that disinflation path is actually on a solid footing. Therefore, the markets are now pricing in a 30% chance of a 50 basis point cut in December by the ECB. On the rupee, what's happening is the market continues to sell stocks. Rather, the FIIs continues to sell stocks and buy the dollar, and putting more pressure on the rupee. So far, it has held its ground around 84.10. Yesterday, Asian currencies were seeing fresh bout of weakness amid sharp rise in US yields, and this, along with continued foreign investor outflows, set the stage for rupee to move a step lower in the coming sessions. Now, as of now, global uncertainties are rising, like the pace at which Fed will cut policies post presidential elections, Middle East war that is continuing. So, in these circumstances, investors are choosing to buy into the safety of the dollar. So, year-end repatriation from FIS has also gained further with the pressure on domestic stocks and the rupee as well. So a gradual break around 84.10 towards 84.25 is not ruled out in the coming days, particularly if the run up to the US elections. And by the time the US elections are out and the new president and its policies are somewhat hinted, I think we would be actually seeing the FIs completing their year-end repatriation as well. So I think this is an ongoing process that will continue for some more weeks, and the rupee is unlikely to see any sort of strength. Also, looking at the way bond yields have moved globally, it's not surprising to see. It won't be surprising to see if Indian bonds also sell off a bit and FIs take profit on some of their large portfolios. Thank you.
Thank you, JK. Just quickly summarizing, the US Treasury yields rising sharply despite no economic data in place because participants are now betting strongly on a strong Republican majority, resulting in a Trump trade, which has caused a sharp rise in yields because his policies have previously also caused a rise in bond yields. And there are also other reasons for the yields to remain elevated, including the massive deficit the US runs and the bottoming inflation. India and China make comments ahead of the BRICS summit. On the European front, markets are now pricing a 30% chance of a 50 basis point cut by the ECB in December. Domestically, FIs have continued to sell stocks, resulting in a weaker rupee. In fact, even Asian currencies are seeing some weakness. So 84.10, which is well protected, may be under threat, and we may move to 84.25. That's it from us, right? Thanks for listening. Tune in tomorrow for the latest of the financial markets.